The Roaring Twenties. It was an era of unprecedented optimism, a seemingly endless party fueled by jazz, flapper dresses, and a stock market that only ever went up. Americans, from industrial tycoons to shoeshine boys, believed they had discovered the secret to permanent prosperity. They poured their savings and often borrowed money into the market, convinced that riches were just around the corner. But on October 29, 1929, the party came to a screeching, violent halt. The opening bell that morning didn't signal another day of gains. It unleashed a tidal wave of pure, unadulterated panic that would become known as Black Tuesday. The technology that had symbolized the boom now chronicled its demise. The ticker tape machines, once messengers of fortune, became instruments of doom. They couldn't keep up with the sheer volume of selling, falling hours behind the trading on the floor. When the numbers finally printed, they told a horrifying story of collapse. 16 million shares were traded in a single day, a record that would stand for nearly 4 decades. But these weren't trades, they were acts of desperation. For every seller, there was no buyer, and prices plummeted into an abyss. The financial nervous system of the nation short-circuited. Telephone and telegraph lines were overwhelmed. Frantic investors who had bought stocks on margin, borrowing up to 90% of the purchase price, were now facing margin calls. Their brokers demanded they cover their losses immediately. The desperate cry of "Sell, sell at any price," echoed from Wall Street to Main Street. But it was a futile plea. The market had become a black hole, consuming everything. The very mechanism of capitalism had seized, and the gears were grinding to a halt. Outside the grand facade of the New York Stock Exchange, a crowd gathered. They weren't rioting. They were watching in stunned silence, their faces a canvas of disbelief and dawning horror. These were the people whose life savings, whose dreams of a better future, were being wiped out inside that building. They were witnessing more than a financial crash. They were watching the bedrock of American confidence and prosperity turn to dust before their very eyes. The illusion of endless growth had been shattered, and no one knew what would come next. The panic was a contagion. It leaped from Wall Street to Main Street, infecting the entire banking system. Fearing that the banks themselves would fail, people rushed to withdraw their cash. These bank runs became a self-fulfilling prophecy. Healthy banks were pushed into insolvency overnight simply because they couldn't liquidate assets fast enough to meet the demand. In the weeks and months that followed, thousands of banks would shutter their doors, taking with them the life savings of millions of Americans who had never even owned a single share of stock. As printing presses worked through the night, the catastrophe was immortalized in bold black ink. "Wall St. lays an egg," read one famous headline, a darkly humorous understatement for a national disaster. "Stock market crashes!" screamed others. The news spread across the country and the world, confirming the worst fears of a nation waking up to a new, terrifying reality. The numbers were staggering. In a matter of days, the market had lost over $30 billion, more than the entire cost of World War I. In living rooms across America, from opulent mansions to modest apartments, families huddled around their radios, listening as somber voices delivered the grim news. For the new class of investors, the paper millionaires of the 1920s, the ruin was absolute. Fortunes built on speculation and borrowed money had vanished into thin air. The silence in these rooms was deafening, filled only with the crushing weight of what was lost and the terrifying uncertainty of what lay ahead. The vibrant, chaotic energy of the Jazz Age evaporated. The streets of the financial district, once symbols of ambition and endless possibility, now felt hollow and haunted. The crash didn't just silence the ticker tapes, it silenced the very rhythm of American life. The roar of the 20s was replaced by a somber, uncertain quiet, a prelude to a decade of hardship unlike any the nation had ever known. The temples of finance became tombs. Brokerage offices, where fortunes were once made with a simple phone call, were now scenes of devastation. They were the epicenters of the financial earthquake, stark monuments to the hubris and speculative fever that had preceded the fall. The party was officially and brutally over. But Black Tuesday was not the end of the story. It was the beginning. The stock market crash was the trigger that fired the starting gun on the Great Depression. As credit dried up and confidence evaporated, businesses failed and factories fell silent. Unemployment skyrocketed. For millions, the immediate consequence was a struggle for basic survival. A new grim feature appeared in American cities: the breadline. Men who once built skyscrapers and forged steel now stood for hours, waiting for a piece of bread and a bowl of soup. The Depression seeped into every corner of American life. hitting families the hardest. The loss of a job or savings meant a direct daily battle against hunger and homelessness. A meager meal became a blessing, yet, amidst the profound hardship, a quiet, steely resilience took hold. It was a determination to endure, to hold the family together, and to survive the storm. This spirit would come to define a generation. For those who lost everything, the last resort was a shantytown, derisively nicknamed Hoovervilles. After the president many blamed for the crisis, these communities of shacks became a visceral symbol of the crash's long-term consequences. They were a stark reminder of how a financial crisis born of speculation on Wall Street had cascaded into a profound human crisis across the entire country, turning the American dream of the 1920s into the enduring nightmare of the 1930s.
To understand modern finance, we must look back. Nearly a century ago, an economic cataclysm unfolded that would not only define a generation, but would also reshape the architecture of the global financial system, the Great Crash of 1929. Its lessons are not relics. They are living principles, etched into the regulations and market psychologies we navigate today. The ghosts of 1929 still walk the halls of Wall Street, and understanding their story is crucial to preventing their return.
The Roaring Twenties were a period of intoxicating optimism. New technologies like automobiles and radios fueled a sense of endless prosperity that spilled over into the stock market. It was no longer just for the elite. Ordinary people were encouraged to participate. The mantra was, "Get rich quick," and for a while it seemed to work. The Dow Jones Industrial Average quintupled in just 5 years. A key driver was buying on margin, where investors could borrow up to 90% of a stock's price. This leverage magnified gains, creating an illusion of wealth. But it also created a ticking time bomb, a system of immense fragility where the slightest downturn could trigger a catastrophic cascade of forced selling.
But beneath the glittering surface, the economic foundations were cracking. While industrial profits soared, wages stagnated, creating a vast chasm of wealth inequality. The agricultural sector had been in a depression for most of the decade. Furthermore, the banking system was a chaotic patchwork of thousands of small, undercapitalized banks with no federal deposit insurance. These were the deep structural weaknesses that the speculative fire of the stock market would eventually ignite into a nationwide conflagration.
What we see is a classic speculative bubble. The price of stocks became detached from their underlying fundamental value. People weren't buying a share in a company for its long-term profitability. They were buying it because they believed a greater fool would buy it from them for a higher price tomorrow. It's a psychological phenomenon. Herd behavior takes over. The fear of missing out becomes more powerful than the fear of losing. In such an environment, traditional valuation metrics are dismissed. "This time is different," becomes the dangerous refrain. But it's never different. Every bubble throughout history has eventually met its pin.
When the bubble burst in October 1929, the fallout was brutal. The system of margin calls created a death spiral of selling. The ensuing Great Depression laid bare the complete failure of the existing regulatory environment. The market was seen as a self-correcting mechanism, but it had failed spectacularly, wiping out the savings of millions. The public outcry was deafening, demanding accountability and a new set of rules to ensure it could never happen again. The era of laissez-faire was over. The age of regulation was about to begin.
The response was a flurry of landmark legislation under President Roosevelt's New Deal. The Securities Act of 1933 required companies to provide complete and accurate information to investors. The following year, the Securities Exchange Act of 1934 created the SEC, a federal watchdog with authority to regulate markets and pursue fraud. But perhaps the most direct response was the Glass-Steagall Act. Its most famous provision erected a firewall between commercial banking, which takes deposits, and investment banking, which deals in securities. The logic was simple. Banks holding the public's savings should not be allowed to make risky, speculative bets with that money. It was a foundational piece of legislation that would define American banking for over half a century.
The 1990s dawned with optimism. The Cold War was over and a new digital frontier was opening. The internet, once a niche academic tool, was going mainstream. In garages and offices, a new generation of entrepreneurs believed they could change the world, weaving a new society where communication and commerce would be instantaneous. The epicenter of this earthquake was Silicon Valley. It transformed into a modern-day boomtown, with cranes erecting new office parks overnight. Capital poured in, chasing the promise of a digital gold rush. This wasn't just about building companies, it was about building a new economy, and the promise of wealth drew in the brightest minds. This digital revolution had a public scoreboard, the NASDAQ. It became the index for the new tech economy, and the world watched as the numbers climbed, defying gravity. The ticker became a hypnotic symbol of a market detached from old-world fundamentals like profit. It was a new paradigm, or so everyone believed. The ultimate validation was an initial public offering. Going public was a coronation, creating paper millionaires overnight. The ringing of the opening bell, followed by champagne, became a ritual celebrating this new, effortless path to wealth. The focus wasn't on sustainability, but on the first-day pop of the stock price. It wasn't just Wall Street pros. Online brokerage firms democratized stock trading, and anyone with a computer could be a day trader. Ordinary people quit their jobs to ride the tech wave, buying stocks based on chat room tips. This flood of retail money added fuel to the speculative fire, pushing valuations even higher. The mania centered on the .com. Any business plan could attract millions just by adding .com to its name. The logic was based on attracting eyeballs, not profits. Companies like Pets.com spent fortunes on Super Bowl ads but lacked a viable business model. It was a time of irrational exuberance where a story was worth more than a balance sheet. At the heart of this frenzy were venture capitalists, locked in a frantic race to back as many .coms as possible. The fear of missing out on the next Amazon was so intense that due diligence was often cursory. VCs weren't just funding businesses, they were manufacturing IPOs, hoping to cash out before the music stopped. This paper wealth created a culture of conspicuous consumption. 20-something programmers with valuable stock options bought Ferraris and threw lavish parties. The .com boom was a cultural phenomenon, celebrating youth and disruption, and the idea that old rules no longer applied. This display of new money reinforced the public's belief that the boom was real. But by early 2000 the foundation was cracking. Many .coms were burning through cash with no path to profitability. The burn rate became a terrifying metric. As money ran out and funding dried up, the lavish offices began to empty. The first for-lease signs appeared in Silicon Valley windows. The party was ending. The tipping point came in March 2000. After a 5-year run where the NASDAQ increased by over 400%, the bubble burst. Interest rate hikes by the Fed and a major sell-off by institutional investors triggered a panic. The decline was as swift and brutal as the rise had been euphoric. What went up like a rocket came down like a stone. The crash had a devastating human cost. Paper fortunes vanished as stock prices plummeted. Mass layoffs swept through the tech industry. The same optimistic workers lured by stock options now found themselves in unemployment lines. For many, the dream of the new economy had turned into a nightmare. In the aftermath, Silicon Valley looked like a ghost town. Its empty office parks a testament to trillions in vaporized shareholder value. The .com bust was a painful lesson in market psychology and sustainable business. Yet, amidst the wreckage, the infrastructure and ideas remained. The first chaotic chapter of the internet revolution was over, but the story was far from finished. As we stand at the precipice of a new economic era, the very foundations of our financial world are shifting. The future is no longer a simple extrapolation of the past. It's a complex tapestry woven from threads of unprecedented technological innovation, profound environmental challenges, and evolving human behavior. Navigating this landscape requires more than just traditional wisdom. It demands a new level of awareness, adaptability, and foresight. The risks are more interconnected, the opportunities more disruptive, and the stakes higher than ever before. Nowhere is this disruption more apparent than in the explosive rise of digital assets. Cryptocurrencies, born from a vision of decentralized finance, have captured the imagination of millions. They promise a world free from intermediaries, with faster, cheaper, and more accessible transactions. Yet, this promise is shadowed by extreme volatility. Fortunes are made and lost in the blink of an eye, driven by social media sentiment, regulatory whispers, and the inherent complexities of a technology still in its infancy. Understanding this new asset class is no longer optional for the modern investor. It's a critical piece of the future financial puzzle, but one that must be approached with extreme caution. The underlying blockchain technology holds immense potential to revolutionize everything from supply chains to voting systems, but the path from speculative asset to stable store of value is long and fraught with uncertainty. Investors must look beyond the hype and critically assess the fundamental value, the security risks, and the evolving regulatory frameworks that will ultimately determine the fate of this digital frontier. While digital storms rage on our screens, a more tangible and systemic threat is gathering force: climate change. For decades, this was considered an environmental issue, separate from the world of finance. That is no longer the case. Climate risk is now financial risk, period. It manifests in two primary forms. First, there are the physical risks, the direct costs of extreme weather events like hurricanes, wildfires, and floods, which can destroy infrastructure, disrupt supply chains, and render assets worthless. Insurance companies are already repricing this risk, and soon, all asset classes from real estate to municipal bonds will have to account for it. Second, there are the transition risks. As the world inevitably moves towards a low-carbon economy, industries reliant on fossil fuels will face immense pressure. Companies that fail to adapt will see their business models collapse, while those that lead the green transition will unlock enormous value. This global shift is creating a wholesale repricing of assets, forcing investors to look at their portfolios through a new climate-aware lens. ESG, environmental, social, and governance. Investing is moving from a niche strategy to a mainstream necessity, not just for ethical reasons, but for pure financial prudence. Simultaneously, another revolution is unfolding, this one inside the trading floors and data centers of Wall Street. Artificial intelligence is reshaping the mechanics of the market at a breathtaking pace. Sophisticated algorithms now execute the majority of trades, operating at speeds and scales far beyond human capability. Machine learning models sift through petabytes of data, from earnings reports and satellite imagery to social media sentiment, searching for predictive patterns that can provide a competitive edge. This brings incredible efficiency and the potential for more accurate risk assessment.
New AI models can identify risk patterns earlier than before. They can spot subtle correlations and anomalies that human analysts might miss, offering a powerful early warning system for potential market dislocations. However, this algorithmic arms race also introduces new, insidious risks. The black box problem, where even the creators of an AI don't fully understand its decision-making process, is a major concern. What happens when thousands of these complex, opaque algorithms interact in the market? We've already had glimpses of the danger with flash crashes, where markets plummet and rebound in minutes, triggered by cascading algorithmic sell-offs. As AI becomes more autonomous, the potential for a systemic crisis driven by non-human intelligence is a scenario that regulators and market participants are grappling with. The challenge is to harness the power of AI for good while building robust guardrails to prevent it from becoming a source of catastrophic instability. So, in a world defined by these new, complex, and often correlated risks, how can the individual investor hope to survive, let alone thrive? The answer begins with a principle as old as investing itself, now more critical than ever.
Build a diversified portfolio to weather future market storms. But diversification in the 21st century means more than just a mix of stocks and bonds. It means thinking globally across different economies and currencies. It means looking across asset classes, including real estate, commodities, and perhaps a small, carefully considered allocation to alternative assets like cryptocurrencies. The goal is to build a portfolio where the components don't all move in the same direction at the same time. When tech stocks are down, perhaps energy or healthcare is up. When one country's economy is struggling, another may be booming. This strategy doesn't eliminate risk, but it smooths the ride, protecting you from the catastrophic impact of a single-point failure in your portfolio. It's about building a financial ark, sturdy enough to handle the unpredictable waves of multiple simultaneous storms. Beyond diversification, the most powerful tool against market panic is liquidity. In times of crisis, cash is not just king, it's the entire kingdom. This is where an emergency fund becomes your financial bedrock. This isn't investment money, it's insurance money. A readily accessible pool of cash, typically 3 to 6 months' worth of living expenses, serves a singular vital purpose. It prevents you from being forced to sell your long-term investments at the worst possible moment. When the market is in freefall and fear is rampant, having a cash buffer allows you to ride out the storm without locking in devastating losses to pay for an unexpected car repair or medical bill. It provides peace of mind and, more importantly, the discipline to stick to your long-term strategy when your emotional instincts are screaming at you to sell everything. And that brings us to the most challenging, yet most rewarding aspect of successful investing: perspective. Financial markets are forward-looking, but they are also deeply cyclical and prone to bouts of mania and despair. History is our greatest teacher here. From the tulip mania of the 1600s to the dot-com bubble of 2000 and the global financial crisis of 2008, every generation of investors believes this time is different. And while the details change, the human psychology of fear and greed remains constant. The greatest fortunes are not made by timing the market, but by time the market. The key is to resist the primal urge to react to short-term noise.
Stick to long-term plans. Don't let short-term panic drive decisions. This means embracing strategies like dollar-cost averaging, where you invest a fixed amount of money at regular intervals, regardless of market highs or lows. This disciplined approach forces you to buy more shares when prices are low and fewer when they are high, effectively lowering your average cost over time and smoothing out the bumps of volatility. It transforms market downturns from a source of terror into an opportunity to accumulate assets at a discount. It's a simple, powerful technique that removes emotion from the equation and aligns your actions with your long-term goals. Of course, individual investors are not alone in this new world. Governments and central banks are acutely aware of the evolving risk landscape and are preparing their own responses. Their role as guardians of financial stability has never been more complex.
We stand ready to use all available policy tools. This statement, often heard from central bankers, reflects a commitment to intervene during times of crisis. They can lower interest rates, provide liquidity to the banking system, and engage in quantitative easing to support asset prices. However, they face a difficult balancing act. The tools used to fight a financial crisis can also fuel inflation or create asset bubbles. Furthermore, new challenges like cryptocurrency defy traditional monetary policy frameworks. How do you regulate a decentralized asset? How do you ensure financial stability when a significant portion of value exists outside the traditional banking system? Lawmakers and regulators around the globe are racing to create new rules for the digital age, rules for crypto exchanges, for the ethical use of AI in lending and trading, and for corporate climate risk disclosures. The coming decade will be defined by this regulatory catch-up, which will undoubtedly create both headwinds and tailwinds for investors. The future of finance will be a dynamic interplay between disruptive technology, systemic environmental pressures, and timeless human behavior. It will demand more from us as investors, more education, more discipline, and more resilience. The path forward is not about finding a magic bullet or predicting the next big thing. It's about building a robust framework grounded in proven principles.
Planning now gives you security even through market volatility. By understanding the new risks on the horizon, from crypto volatility to climate impact, by embracing the power of diversification and a long-term perspective, and by recognizing the crucial role of liquidity, you can construct a financial plan that is not just built to survive the future, but to thrive in it. The storms will come, but with careful preparation, you can ensure you are on solid ground, ready to navigate whatever lies ahead.
Market crashes are temporary, but the lessons they teach are timeless.